Dear students, coming back to financial management, we were dealing with working capital management, and one of the first videos of working capital management, I told that there are various policies adopted by by an organization for maintaining its working capital. Whether the company is following conservative policy, average policy, aggressive policy, etc. I had explained in the first theoretical portion of working capital management. Let us check this graph. Okay, it is the same graph which I had taken from the I.M. Pandey textbook. I will explain it in the written way. See, when we take this graph, you could see that output of the organization is given in the x-axis. Output in production in units, we could assume, and level of current assets is given in the y-axis. Assume that it's the amount in lakhs, which is mentioned here in rupees. Keeping the fixed asset constant, you could see that a straight line is drawn under the 3 lakh rupees. Straight line is drawn. Fixed assets is kept permanent in the organization. Usually the fixed assets will not change. You could say that in any balance sheet, fixed assets, unless otherwise new investment is the fixed asset remains constant. Fixed assets, maintaining fixed assets permanently. What a firm will do? A firm will leverage its current assets. Leverage means increase. You could see that in the first case, you see this one, first line, which is going like this. It means that current assets, in the y-axis, current asset, around 3.4 lakhs rupees current assets they are maintaining. Here we will mark the current assets. So fixed assets to current asset ratio is lower. The firm will be adopting aggressive policy. Once more I will tell, making fixed assets constant, the firm is only leveraging a little bit more of portion as current assets. It is called as aggressive policy. Such firms will have lower liquidity and higher higher risk, and firm having higher current assets. You could see up to 7 lakh rupees current assets they are investing, and the fixed asset remains the same from A to this portion. Current assets is maintained. Such firm is having conservative policy because the firm is depending more on current assets rather than fixed assets. And if the firm comes, the line comes between this conservative and aggressive policy, it is called as moderate or average policy. Usually majority organization working around us will be following moderate or average policy. Why? Because there is something called risk return trade-off. What it indicates? Risk return trade-off. See, the firm could operate its current assets using its working capital, or the firm could depend more upon the long-term financing. Which one is better is determined under the risk return trade-off. A firm which is depending more on short-term assets, for example short-term loans, it's a source of finance using working capital. Cash credit is a source of finance for working capital. Overdraft facility is a source of finance for working capital. Trade credit, letter of credit, commercial paper, these all things you have studied under the money market instruments. It's a source of working capital. The firm could work with this short-term finance rather than depending on the long-term finance. That is called as the firm will be applying conservative policy and depending more on current assets rather than fixed assets. A firm with conservative policy will be having higher liquidity because their income is mainly dependent on the current assets. Okay, higher current assets to fixed asset ratio will be there. Based on this, a problem is we have to study under the working capital management. That problem is taken from I.M. Pandey again. There is a problem under page number 836, problem 22.3 and problem 22.4. These are the problems based on the maintenance of working capital or working capital investment policies. Okay, let us check this problem. What are the informations given? Under this problem, the engineering company's information is given. Engineering company's information is given. That is fixed asset of that company is 2.6 crore. Current liability is given, which is 2.34. Sales and profit, some information is given, that is sales and profit depends upon the current assets. And investments, especially on inventories and book debts, that is given. And current asset position, estimated sales and EBIT, earnings before interest and tax, in crores is given under conservative policy, under moderate policy and aggressive policy. Then in the question they are asking, what are the changes that happens in the return on total assets, net working capital, current asset ratio, current assets to fixed asset ratio? It's a very easy question because directly you could find out all these things under various situations. So we will do the problem like this. Working capital investment policies, we will put the heading. Under conservative policy, moderate policy and aggressive policy, amount in crores, what are the changes we are going to test? So first what we do is that, first we take current assets. Current assets is given. See what is it? 4.5 under a conservative policy, 3.9 under moderate, aggressive 2.6. That we are posting. Fixed assets it's given. Fixed assets remains constant. So 2.60 is applied for all the cases. Conservative, moderate and aggressive 2.60 common. If we take these two, current assets and fixed assets, we will get total assets. Why we are finding out total assets? Because in the question they had asked return on total assets. So we have to find out total assets. So taking A plus B, we will get total assets. Then current liabilities, A, B, C, D, like that you are putting. No, in order to see the calculations. Current liabilities, it's given in the question 2.34, that we are putting same in all the cases. Conservative, moderate and aggressive current liability, it is the same. Forecasted sales is given or estimated sales is given 12.30 under conservative, 11.50 under moderate and 10 under aggressive policy, that we are posting. Expected earnings before interest and tax or profit before interest and tax also we are posting it here. Now we are going to find out the questions. Return on total assets. What do you mean by return? Return is nothing else but profit. Earnings before interest and tax is given. So EBIT, okay, that is no information F. F divided by C. Total assets is C. F divided by C, we will get all the answers. That is earnings before interest and tax divided by total assets under conservative, under moderate and aggressive, we will get the answer. Okay. Return on total asset, that will get it in percentage. Because the EBIT divided by total assets, we will find out always in percentage. It's in return. Return will be calculated in percentages. Okay. Then net working capital. What is the formula for net working capital? Current assets minus current liability. See, A, current assets minus current liability. Current liability is D. A minus D, we will get the net working capital also. Then current ratio. What is current ratio? Current assets divided by current liability. So A divided by D, we will get the current asset ratio. And current assets to fixed assets. A divided by fixed assets. Fixed assets is also given. So we'll get the things. Now coming into the textbook version of the same problem solution, you could see that the same problem only. You could see that under conservative policy, see the changes. Conservative policy, the rate of return is lower when compared with moderate and aggressive policy. Percentage of profit is lower. Whereas the net working capital position is higher under the conservative policy. And current ratio will also be higher when compared with the aggressive and moderate policy adopted by the organization. And current assets to fixed asset ratio will be higher for companies who are following conservative policy. So only these changes we are finding out. The firm will decide based on the information which policy they have to adopt. So it is based on the same thing, same problem in continuation. It's based on the same problem in continuation. We are finding out the next problem. It's a continuation. 22.3 problem in the M. Pandey textbook and 22.4 problem. It's a continuation problem with the same information. Certain changes. They are adding short-term debt and long-term debt. What happens? The return on equity also they are finding out. Return on equity shareholders. These two pages I will scan for noting the questions and answers. In the continuation problem, what we are doing is that, hence the firm is adopting moderate policy. As I told, usually moderate policies will be adopted by the organization. Firm is adopting moderate policy. What we are doing, current assets, again we are doing conservative, moderate policy and aggressive policy, 3 columns. The current assets, we are choosing the moderate policies current assets. Make it very clear. Moderate policy current asset is how much? 3.9. So it's also given in the question. Company is adopting, choosing the moderate working capital policy. So the same, we are not posting different current assets here. Same policy, because the company had chosen moderate policy. They are testing what happens to the return on equity. Okay. So that is what they had asked. What are the changes that had happened in the return on equity, net working capital and current asset ratio or current ratio position? Other calculations are same. Only thing is that here long-term debt and short-term debt is given and equity capital is given, so that we will get what? No, we will get the total capital of the organization. That is the change which we are doing. Similarly, as the short-term and long-term debt fetches interest, we have to calculate the interest on it. Okay, based on the information given. And the tax rate is also given in the question. Tax rate is 35%. So tax rate on the profit on the PBIT we will be calculating. That is another change, and we will find out what is the profit after tax picture and test the new thing. What are the changes that had happened in the return on capital? Return on equity capital. What is the return on equity capital formula? Return on equity capital formula is profit after tax. Okay, that is 16. Profit after 16th calculation. Profit after tax divided by equity capital. Equity capital is given in the question. Profit after tax, return on equity capital we are finding out. Profit after tax divided by equity capital. We'll get in percentage. And net working capital as usual. Current assets minus current liabilities. Okay. Current assets, information current assets minus current liabilities. Current liabilities, it is given in the question. You could find out these calculations while I am sending the scanned copy. And the current ratio also we are finding out here. Current assets divided by current liability. Only change we have to notice here is that under conservative policy, the return on equity capital will be less, whereas aggressive policy, return on equity capital will be higher. And the other cases, it will be usually conservative policy, the net working capital and current ratio will be higher. So this is no direct calculation of problems. These both problems, it's very easily and directly you could calculate. These problems are there, as I told, in the problem 22.3 under I.M. Pandey, page number 836 and 837 and 838. The answer continued. You could see this problem. I will send the scanned copies. So this is another set of problem in working capital. Here only thing what we are doing is that we are finding out the changes in the working capital position because of the leverage that is happening in the working capital. A firm with higher current assets, those are current assets, higher current assets will be having high leverage of working capital, and such firms will be conservative policy. A firm with lower current assets, lower current assets will be following aggressive policy. Lower current assets in the sense current assets to fixed assets, and higher current assets means higher current assets to fixed assets will be having aggressive policy, and the medium firm will be, or moderate firm will be having in between position between conservative and aggressive policy. Here from the academic side, what you have to do is that you have to test the net working capital position, the profit position, the current assets to fixed assets position, and the leverage position, etc., because of the policies adopted by the organization under working capital, whether it is conservative, aggressive or moderate policy. Because based on the risk return trade-off, the firm may choose which financing they have to depend, whether it is short-term financing or long-term financing. Long-term financing is highly expensive because we have to pay more on interest for the debentures and long-term borrowings. Whereas short-term financing like short-term loans, it is less interest. So that's easy to maintain short-term financing, but the rotation or working capital cycle also should be very careful in order to play with the working capital position. So you have to generate more cash and more, maintain more liquid position by collecting the bills, receivables and debtors, etc., and go for average or conservative policy of working capital. That is what we are studying under the working capital management fourth problem. So this is all about the conservative policy, aggressive policy and average policy adopted by the organization and changes in the net working capital or return on equity capital or the working capital leverage position of the organization. Thank you.